Ben Bernanke, Banks, Monetary Policy and Financial Crises by Kurosh McKay. Who is Ben Bernanke? Bernanke served as the chair of the Fed from 2006 to 2014, a time that included the 2008 financial crisis. Bernanke had a strong history in economics and was a professor at Princeton. He was recognized for his pragmatic approach, focused on stabilizing the economy. His role during the crisis became a defining aspect of his legacy, as he led efforts to prevent a deeper recession through the Fed's monetary policy tools. Banks are the backbone of our economy with three foundational roles. First, they provide credit by supplying loans to individuals and businesses, which fuels economic activity and growth. Second is investment. Banks invest funds into key sectors such as infrastructure, technology, and housing. These investments drive economic development. Third is stability. Banks manage financial stability by regulating the flow of money and preserving confidence in the financial system. These practices are essential for a healthy economy. During financial crises, these roles are often disrupted. What is monetary policy? Monetary policy are actions taken to control the amount of money in circulation and the cost of borrowing. The goal is to stabilize the economy, control inflation, and promote economic growth. Also, the Fed operates on a dual mandate. They aim to promote maximum employment and ensure stable prices. There's two types of monetary policy. Expansionary monetary policy is used during economic slowdowns or recessions. A recession is a sustained period of economic decline that lasts more than a few months. By lowering interest rates, the Fed makes borrowing cheaper, which stimulates spending and investment. Contractionary monetary policy is used to combat inflation. Inflation is an increase in the price of goods and services over time. It can also be described as a decrease in the value of currency. The Fed raises interest rates, making borrowing more expensive. In times of a financial crisis, the Fed's focus is primarily on expansionary monetary policy. The Federal Reserve has a few key tools to stabilize the economy. Cutting interest rates is one of the most common methods and makes borrowing cheaper and encourages spending and investment. Another tool is liquidity provision. This tool ensures that banks have enough funds to meet their obligations, preventing a freeze in lending. Without liquidity, banks will stop lending to consumers and businesses, bringing the economy to a halt. During his time with the Fed, Bernanke also introduced a new tool known as quantitative easing. This tool injects money directly into the economy by purchasing securities, such as treasuries. This was a unique approach that helped banks maintain the necessary liquidity during the 2008 crisis. The 2008 financial crisis was a result of three main factors as shown. To summarize the course of events, first, house prices rose. During this rapid growth, banks issued subprime mortgages to borrowers with poor credit and unstable income. These pools of mortgages were put together in investments known as mortgage-backed securities, which were then sold to other banks and investors globally. Eventually, the housing market crashed, or the bubble burst, and borrowers defaulted on their payments, leaving banks suffering and rendering mortgage-backed securities worthless. When we look at all of these factors, we see that they're interconnected, and the crash of housing prices led to a spiral of chaos for the U.S. economy during this era. In order to better visualize the risky lending practices mentioned in the slide before, let's take a look at this graph. This graph shows delinquency rates on different types of mortgages from 2000 to 2010. The delinquency means that a borrower fails to make a payment. As we can see, subprime adjustable rate mortgages, which are in pink, had the highest delinquency rates, peaking close to 45% around 2009. These were high-risk loans often given to borrowers with poor credit. As the financial crisis unfolded, Bernanke and the Fed took decisive action to stabilize the economy. They lowered interest rates to near zero to make borrowing cheaper and stimulate spending. Bernanke also introduced quantitative easing, as mentioned before, which is a method of injecting money directly into the economy by purchasing government and mortgage-backed securities. This helped keep the financial system running. Additionally, the Fed created emergency lending programs to provide liquidity to banks in need, helping prevent a total collapse of the financial sector. Bernanke's goal was to keep credit flowing to businesses and consumers, avoiding a deeper recession and setting the stage for recovery. In a speech given in 2012, Ben comments on the steps taken to support the economy. He says, quote, "To support economic recovery, we have taken unprecedented steps to provide liquidity directly to key markets and to create facilities that address the specific weaknesses in these markets." This quote gives us a view on Bernanke's use of liquidity provision and how he tailored the Fed's recovery strategy to provide liquidity to key markets in order to stabilize the economy. This graph illustrates the impact of the 2008 financial crisis on GDP by comparing actual GDP to potential GDP. Potential GDP represents the level the economy could have achieved without the crisis, while actual GDP shows what was actually achieved. As we see, there's a large gap between actual GDP and potential GDP following the crisis, meaning the economy was underperforming compared to its potential. This gap persisted for years, showing how deeply the recession affected economic growth. In a speech given by Bernanke in 2009 regarding the crisis and policy response, Bernanke states, The damage, in terms of lost output, lost jobs, and lost wealth, is already substantial. The global economy will recover, but the timing and strength of the recovery are highly uncertain. This quote does a good job at capturing the uncertainty regarding the path to recover. Bernanke's leadership fundamentally reshaped how monetary policy is understood and implemented. His innovative strategies, such as quantitative easing, helped stabilize the U.S. economy during the 2008 crisis and set a precedent for future crises. For instance, many of the tools he pioneered were used during the COVID-19 economic downturn to prevent similar damage. His focus on reducing systemic risks within financial institutions has had lasting impacts, improving the resilience of the financial system. Bernanke's legacy is defined by his ability to adapt monetary policy to meet unprecedented challenges, leaving a model of crisis management that continues to influence policymakers today. Thanks.